Many traders operate under the illusion that market legends possess a vast library of chart patterns, a set of secret indicators, or some elusive holy grail hidden from the public eye. If this is your viewpoint, allow me to be the first to tell you that you are profoundly mistaken. The reality is precisely the reverse. Consider this. On any given day, millions of traders are glued to their screens, sifting through a sea of indicators and bouncing between an endless array of strategies. They might trade breakouts on Monday, follow moving averages on Wednesday, and spend their weekend deciphering Elliott wave theory. Their belief is that more knowledge equates to more security. In truth, they are simply getting lost in a labyrinth of complexity. And complexity is the adversary of effective execution. The most accomplished traders in history have always favored simplicity. They don't squander their energy trying to become experts in every conceivable trading method. Their approach is to go deep, not wide. They prioritize simplicity, depth of understanding, and the complete mastery of a select few methods with a proven track record. As Bruce Lee famously stated, "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." This principle is a direct parallel to trading. The trader who experiments with 50 different patterns will never truly master any of them. In contrast, the trader who dedicates themselves to a single setup, applies it with unwavering discipline, and grasps the underlying psychology, is the one who ultimately succeeds. History provides the proof. The legendary Nicholas Darvas perfected his box theory. Richard Dennis and the turtle traders adhered to a singular trend-following system. Jesse Livermore operated by the fundamental laws of supply and demand. And Mark Minervini, one of today's greatest living traders, built his immense wealth not by knowing everything, but by committing fully to one pattern he named the Volatility Contraction Pattern, or VCP. This was Minervini's key to transforming a modest starting account into a fortune that would grow to over $72 million. It wasn't achieved through some mystical formula or exclusive information. It was the result of simplifying, mastering, and repeatedly executing one high-probability setup. And that is precisely what we are going to explore today. In this video, you will learn two critical things. First, how Mark Minervini used the VCP to become a trading icon, and second, how you can use this very same pattern on stocks in the current market. Part 1. How Mark Minervini earned $72 million with the VCP. Mark Minervini is more than just a trader with an impressive financial record. He is among the rare few who have publicly demonstrated that exceptional results are attainable when skill, discipline, and a sound method converge. He is a two-time winner of the U.S. Investing Championship, a feat that immediately elevates him above his peers. In 1997, Minervini took the trading community by storm by achieving a jaw-dropping 155% return in just 5 months, earning him first place. Over 2 decades later, he returned to prove his success was no accident. In 2021, he entered the competition again and produced a 334% return, claiming the title for a second time and confirming that his strategic edge was as sharp as ever. Throughout his career, he compounded these types of gains into a fortune exceeding $72 million, turning a small initial stake into life-altering wealth. But the championships and figures, impressive as they are, reveal only a fraction of his story. What truly defines Minervini is his trading philosophy. He authored 2 highly regarded books, Trade Like a Stock Market Wizard and Think and Trade Like a Champion. Both texts encapsulate his core belief that success in trading doesn't stem from knowing 1,000 strategies, but from mastering one repeatable process and applying it with relentless consistency. For him, that process is centered on a single setup, the Volatility Contraction Pattern, VCP. The concept behind the VCP is deceptively straightforward. Picture a stock that has already experienced a significant upward move. At some point, this momentum pauses. Instead of continuing its ascent, the stock begins to move sideways, consolidating its recent gains. During this consolidation, the price action is not random. It begins to contract. The initial pullback might be substantial, perhaps a 25–30% drop from its peak. The next time the stock pulls back, the decline is less severe, maybe 15%. This is followed by another contraction of only 8%, and eventually the stock might dip just 4–5% before buyers re-emerge. With each successive contraction, the price swings become tighter, and trading volume typically recedes. This pattern sends a powerful signal. Sellers are losing their influence. Each attempt to rally faces diminishing resistance, and each pullback becomes shallower. From a psychological standpoint, this is perfectly logical. The initial profit takers have sold their shares and moved on. The less committed, weak hands have been shaken out of their positions. All the while, steadfast buyers who believe in the company's prospects are watching, waiting for the optimal moment to enter. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below. As volatility contracts and volume dries up, the balance of power decisively shifts. By the time the stock is pressing against the upper boundary of this consolidation area, the available supply of shares has been largely absorbed. When the breakout finally occurs, often on a surge of volume, it can trigger an explosive upward move. Demand has overwhelmed supply, and the stock is ready to begin its next major advance. This is why the VCP became the foundation of Minervini's trading. It provided something few other setups can offer: a high-probability entry point with a clearly defined risk level. The pattern itself creates a logical place for a stop-loss just beneath the most recent contraction, allowing for tight risk management. Simultaneously, it positions a trader to capture the next significant upward leg in a market-leading stock. In Minervini's hands, the VCP was more than just a chart pattern. It was a disciplined framework that aligned perfectly with his core philosophy of protecting capital first while letting winning trades run. Over the years, this single pattern became his one kick, practiced 10,000 times. It armed him with the confidence to be aggressive when the probabilities were stacked in his favor, and the discipline to stay on the sidelines when they were not. It was the method he used to generate triple-digit returns in public competitions, and the same method he used privately to compound his fortune. And this is where the lesson becomes directly relevant to us. The volatility contraction pattern is not some artifact of Minervini's past, nor is it a trick that works only in specific market conditions. It is a principle grounded in the timeless dynamics of supply and demand and human psychology, the very forces that have always driven markets. This means it can be applied today, right now, to the stocks we are all watching. Part 2. Applying the VCP to today's market. After grasping how Mark Minervini mastered the VCP, the obvious question is, how do we put this setup into practice in the current market? Let's examine one of the most powerful recent examples: Nvidia. In 2023, Nvidia experienced a colossal run-up of approximately 250%. This initial powerful move is an essential precondition. In Minervini's methodology, a strong prior uptrend is a non-negotiable requirement for a valid VCP. Why? Because it confirms the stock has already shifted from a weak, downtrending state into a position of strength. It's a clear sign of institutional demand. Without that initial surge, any subsequent consolidation lacks the same predictive power. But this is where it gets interesting. After a stock's value doubles or triples, it's natural for investors to start taking profits. As early buyers cash in, a new wave of supply enters the market. At this point, one of two things will happen. If the company's growth story has concluded, the stock will buckle under the selling pressure and the rally will fizzle out. But if the story remains intact and institutions maintain their belief in its future, then instead of collapsing, the stock will pause, absorb that selling, and begin to tighten into smaller and smaller ranges. That is precisely what unfolded with Nvidia. Following its explosive rally, it didn't crash. It consolidated. The first contraction was about 17%, a sharp but healthy pullback for a stock that had just run up 250%. The second pullback was narrower at 15%. The third came in at 10%. By the fourth and final contraction, the stock was barely dipping 5%. Each pullback was shallower than the one before it. The price swings were shrinking. The volatility was contracting, and the volume on those dips was drying up. In Minervini's terms, the stock was forming a textbook VCP base. Psychologically, this provides powerful evidence of market conviction. Sellers were growing weaker. They either had fewer shares to sell or were no longer willing to part with them at lower prices. Buyers, meanwhile, were quietly stepping in to support the stock on every dip. This tug of war between supply and demand was slowly tilting in favor of the bulls, but it became undeniable during that final contraction. That's when the stock reached its critical pivot point. The way traders act on this is simple in theory, but demands discipline in practice. You draw a resistance line connecting the highs of each contraction. Then you wait. You don't get in early, you don't try to guess the bottom. You wait for the breakout. The moment the stock decisively clears that resistance line, confirmed by a spike in trading volume, that is your signal. That is when the probabilities have aligned in your favor. For Nvidia, that breakout was the trigger for a massive continuation. From that pivot point, the stock surged another 180% in just over 5 months. That wasn't luck. It was the natural consequence of institutional demand overpowering an exhausted supply. Exactly the dynamic the VCP is designed to identify. And this is the brilliance of Minervini's approach. You are not just chasing stocks at random or trading on hope. You are observing the natural rhythm of supply and demand as it plays out on the chart, and you are acting only when the evidence shows that the balance of power has shifted conclusively. At the end of the day, what made Mark Minervini an extraordinary trader wasn't his mastery of hundreds of strategies or his ability to recall every chart pattern ever created. It was the exact opposite. His greatness was born from narrowing his focus to a single powerful setup, the Volatility Contraction Pattern, and dedicating himself to understanding it so profoundly that he could recognize it forming almost instinctively. That is a lesson worth reflecting on. In trading, complexity is alluring. It can feel safer to accumulate more indicators, more theories, more what-if scenarios. But the market rewards simplicity and execution far more than it rewards encyclopedic knowledge. Minervini didn't dilute his efforts across a dozen half-understood methods. He built his mastery around a single repeatable edge. That edge became his compass, his filter, and ultimately his key to a fortune of over $72 million. And that brings us back to you. If you absorb only one idea from this video, let it be this. You do not need to know everything to succeed in the stock market. You simply need one method studied deeply, tested relentlessly, and applied with discipline to put the odds in your favor. That is what Mark Minervini did, and it changed his life. So, here is my challenge to you. What is the one pattern you are going to master? Will it be the VCP with its story of tightening ranges and explosive breakouts? Or perhaps another setup that resonates with your style? Whatever you choose, commit to it. Because focus is what builds mastery, and mastery is what builds results. If this breakdown provided you with value, hit the like button, subscribe, and drop a comment below sharing which chart pattern you're focusing on right now. And if you'd like to support the channel, consider joining as a member or using the Super Thanks button. It helps me continue creating deep dive content like this for you. Remember, trading isn't about being everywhere at once. It's about finding your edge and mastering it. That's how Mark Minervini did it, and it's how you can begin to build your own path to success.